Hey everybody, this is Ray Halstead and Patricia Nass with REH CPA. Today we want to talk about how a small business owner pays himself depending on the type of entity that they are. I've got Patty here with me. Patty, what can you tell us about how the type of entity you have determines how, as an owner, you pay yourself?
So a sole proprietor, that is where the IRS would see yourself as, kind of you and the entity are one in itself. So you don't pay yourself by drawing a salary. You're not on payroll or anything. With that, you just take draws from the company as you need it. You just take owner draws because the IRS sees all that income as being taxed to you. So it's also all of it's subject to self-employment taxes as well.
So you don't pay yourself on a W-2. You
Nope.
just pull money whenever you need it.
Yep,
Okay, just write checks to yourself.
exactly.
Okay. Now, what if you are an LLC? Does that make a difference?
Yeah, so it depends on what type of LLC you are. So if you're a single member LLC, you're going to be very similar to the sole proprietor, right? So same thing, to just take owner's draws. You're treated as a disregarded entity. The IRS doesn't see that as a separate business from you. If you're a multi-member LLC, you're considered a partnership in the eyes of the IRS. So you have to follow the partnership rules on kind of how you would pay yourselves.
Yeah, every so often we'll see a partnership where they actually pay themselves on a W-2 wage, and that's not correct if you're a partner, right?
Right. So the same thing. The partnership is seen as all the income is subject to self-employment taxes. All the net profit from the company comes to you that way. Some of them have agreements in which you have guaranteed payments so that certain partners will take out a little more money than others. And those guaranteed payments, again, are subject to self-employment tax. So all the income from the company that you're getting, whether you take all the draws or not, all that's subject to self-employment.
So what entity would you have to be in order to get a W-2, like an actual employee if you're an owner?
So if you're an S corporation or a C corporation, those are the only two. So an S corporation, you're going to pay yourself on a salary. You're seen as an employee of the company. So with that, you have to also pay yourself a reasonable salary. So the IRS says you got to pay yourself, pretty much what you would pay someone else to perform the job that you're doing. If you don't pay yourself that much, the IRS can say some of your distributions were really salary to you. But so you pay yourself a W-2 as an S corp through the payroll, and then you also have distributions that you can take, which are the profits in excess of what you pay yourself through the payroll. Or there's the C corporation way. So as a C corporation, there's only two ways to take money out of the company: pay yourself on a W-2 or give yourself dividends from the company. Again, the W-2, same thing. You're paying yourself a payroll. You can't take any money out in distributions like you can with an S corp. But the dividends on, if you decide to go the dividends route and take money that way, you're subject to double taxation. So generally, it's recommended to not do it that way. The company pays the tax on it, and then you're paying tax on dividend income as well.
Well, that's really good information, Patty. If you're a small business owner out there and you are confused or want to understand better how to pay yourself, feel free to give us a call and we'll help you out. Thanks.